Dear ladies and gentlemen, dear traders, welcome. This is another episode of the Causality Trading Made Simple. We talked about dumb money positions, we talked about stops, we talked about the interaction between the two, we talked about the time and range principle. And in this episode, we're going to talk about the so-called pre-run countermove principle. So what does it say? As I've written here, in most cases there will be one or several counter moves before the actual main target run occurs. Okay? So let's get into this. Let's look at this example. This time the MTS is below the price, okay? And so what happens? The price will not instantly go to the target, okay? First, it does the so-called pre-run counter move, okay? And then eventually it does a target run. So, of course, looking at the time and range principle we've discussed before, there's an overlap. But the emphasis here is on the fact that most of the time we have actually several counter moves in the opposite direction, all right, before the actual main stop hunt is done. Now, let's go a little bit deeper. Why is that the case? And there are several reasons, but often we have some dumb money sellers in the market, okay, which need to be priced in. All right. Some dumb money sellers are actually entering, so they need to be shaken off first. Often we have their short-term stops within reach. So by doing the counter move, the smart money algos can get rid of the short-term stops and reduce the dumb money sellers, okay? If it takes more moves, they will do more moves. And then once they have been served and priced in, then the smart money can actually conduct the main stop hunt, in this case to the MTS, okay? The same applies, of course, to the LTS as well. And other things such as the order gap zones even, we discuss at a later stage. So this is not complicated to understand, okay? The emphasis is before we have the main move towards this main target, we first have the counter moves. And these may or may not be tradable. Okay, so let's look at some examples from real life. Here, for example, we have the MTS. It comes into the market here. We also have some shorties, all right? So what happens? Boom. Counter move in the opposite direction. These SDS have been cleared. After that, the main target run. Of course, most of the time we don't have this very clean pattern, like a V or A pattern here. Most of the time we have several counter moves. So let's look at the next example. Like here. Yeah. This is the Australian dollar. Here we have the MTS, the main target, and look at that. 1 counter move, 2 counter moves, 3 counter moves, 4. 4 counter moves before the actual target run. Okay, so the handful of counter moves. And by packaging these principles into these realities into those principles, and by giving it a name, I believe it helps you a lot to have this kind of mindset when you're trading that live. Because you will say, wait a second, I'm not yet trading the MTS hunt itself. I will either place a limit to get better prices to get filled on the way down, and then to be in there once the price reverses and takes the target. And advanced traders may even trade the counter moves, but that's more complex, okay? So this principle is not difficult to understand, but it's very important. And the time and range principle goes a bit further by showing that the factors time and range, as I've discussed last time, are exploited to the max. And within that principle, of course, we have all these counter moves. So I believe that this is not very difficult to understand. And take it as a base case. That's the whole point, okay? If you take these as a base case, then your trading will improve. Because most of the time, for one target run, you have a handful of counter moves. Now, the way you trade that is on another chapter. So some people they place a limit to sell here. Some people they wait until the price turns and then sell later. And as I said, aggressive traders may even trade the actual counter move. But then, of course, you need to also place your stop in a reasonable way. If you try to place a stop below the MTS, then your target can't be too close because then you have a bad risk return, yeah? So keep that in mind. These things are relevant for your actual trading. All the best.